This is Nightly Business Report with Sue Herrera and Bill Griffin.
Snapback. Stocks surge. The Dow has its third biggest point gain on record as trade tensions ease and investors pour money into the market.
Where to invest? It is a question a lot of investors are asking lately as they try to navigate the volatility.
Disappearing deductions. A handful of tax breaks are vanishing, but there are a few credits you may be able to grab onto. Those stories and much more tonight on Nightly Business Report for a Monday, March the 26th.
Good evening, everybody, and welcome. Stocks start the week with a jolt. The Dow has its biggest point gain in a decade, leaving last week's rout in the rearview mirror. Investors were encouraged by the cooling of trade tensions and reports the talks were underway to avert a global trade war. So let's get you right to the closing numbers. The Dow Jones Industrial Average soared 669 points to 24,202. The Nasdaq climbed 227, and the S&P 500 rose 70. For the Dow and the S&P, it was their best one-day percentage gain since mid-2015. Bob Pisani leads us off tonight from the New York Stock Exchange.
Stocks surged following reports that the U.S. and China are holding quiet talks to ease the trade rift between them, recouping almost half of last week's losses. Now, there was a modest blip midday right before the European markets closed, brought on by news of rising tensions with Russia over in Europe. But once Europe closed, it was smooth sailing to session highs. The Dow rose more than 600 points. The S&P spiked more than 2%. So why exactly did we get this rally? Well, trade tensions have eased with China and South Korea, and thanks to last week's sell-off, the market's much cheaper than it was at the start of the year. The S&P 500 is trading at about 16 times forward earnings. That's about the historical average. It's a lot cheaper than it was in January when we were trading at more than 18 times forward earnings. In other words, the correction helped reset an overheated market. The key leadership is back. That's important. Tech and financials led the charge. Remember, they're more than 40% of the S&P 500 together. It's hard to keep the markets down when you have those two sectors this strong. In fact, Apple, Amazon, and Microsoft, they're the three largest stocks in the S&P. They were up 3 to 7% today. That's huge. Together, these three stocks are 10% of the whole weight in the S&P 500. All 11 sectors ended higher on the day. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And White House trade advisor Peter Navarro today confirmed those reports of trade talks between the U.S. and China. He said he's hopeful the two countries can work together.
Ambassador Lighthizer and Secretary Mnuchin, at the president's direction and personal direction, they are talking with the Chinese, as we've been doing since day one, and we will continue to do that. And I think we're hopeful there that China will work with us to basically address some of these practices. So I see nothing but bullish signs ahead.
Last week, as you know, the White House announced plans to impose tariffs on up to $60 billion of Chinese products.
In Beijing this weekend were some very well-known and influential American CEOs, including Apple's Tim Cook and Blackstone's Steve Schwarzman. And they were attending the China Development Forum. And as you can imagine, the hot topic was trade. Eunice Yoon has our story.
Fears of a trade war dominated the forum. As co-chair of the event, Apple's Tim Cook called for calmer heads and for President Trump to support policies that promote free trade.
What I've seen over my lifetime is that countries that embrace openness, that embrace trade, that embrace diversity are the countries that do exceptional. And the countries that don't.
Other CEOs shared Cook's concerns, including Blackstone's Steve Schwarzman.
There needs to be a negotiated arrangement between the two countries. And I think it's important to note that most of the types of things that are being discussed from the U.S. side can be delayed in terms of their implementation, and hopefully will be.
Despite the aggressive rhetoric from both sides, there are reports that the two are negotiating behind the scenes. The Trump administration has reportedly handed the Chinese a to-do list that includes a reduction of Chinese tariffs on U.S. autos, more Chinese purchases of American semiconductors, and greater access to the financial sector. I spoke to a source familiar with the discussions who said Chinese officials seem to be willing to cooperate on these issues. They're offering to buy more U.S. semiconductors and accelerate the timeline for greater foreign ownership in securities. Chinese officials also said that President Xi Jinping would highlight more financial reforms at a business forum in mid-April. Today, the Foreign Ministry reiterated again that Beijing is willing to hold talks to resolve differences with the United States. Tomorrow, a small group of American CEOs is going to be meeting with the Vice President Wang Qishan, a very close ally of President Xi Jinping. For Nightly Business Report, I'm Eunice Yoon in Beijing.
The other big story in the market, it's still Facebook. A number of developments there. The social media company is now the target of an FTC probe. The agency is looking into Facebook's data and privacy practices. Separately, the company has acknowledged now that it does save extensive call and text data made by Android users when those users opt in to the feature. And CEO Mark Zuckerberg has now been asked to testify by the Senate Judiciary Committee. The stock spent much of the day lower. In fact, it was down 5 or 6%, but it finally eked out a small gain at the close to $160.06.
The tech sector overall bounced back today, but it's had a hard run of late. And as Mike Santoli reports, it may be time to rethink the way we invest in this group.
The stock market has almost never been as reliant on the technology sector as it is today. And suddenly, big tech is suspect. The industry is under fresh regulatory pressure over misuse of customer data, with Facebook at the center, and tech stocks are being newly scrutinized by investors who have spent the past few years paying up aggressively for shares of the most powerful internet companies, excited for a digital future that is now looking less clear and bright. Facebook's role in allowing user data to be used to target election ads has driven a nasty sell-off in its stock and caused investors to rethink the value of leading internet platforms. The reason Facebook, Google, Amazon, and Netflix were so popular on Wall Street in recent years was their natural dominance in businesses where the winners take most of the rewards. Now, that very dominance is making these companies targets. The stock market implications are significant. The tech sector, including Amazon and Netflix, which are technically in the consumer category, now makes up about 30% of the S&P 500 index. And big tech over the past year has become valued at a substantial 20% premium to the overall market based on stock price to earnings multiples. So if investors become less willing to accept such rich valuations, the broad market would be held back or weighed down. Of course, this could simply be a temporary market panic over some alarming but fleeting headlines. Facebook stock, for one thing, has never been as cheap based on its expected profits, which are still set to grow close to 20% this year. And the good news is that outside of tech, large cap stocks look quite a bit less expensive than they did just 2 months ago before the market pullback. When the clear driver of the market runs into trouble, as tech has lately, rallying around new leadership can be a nervous and messy process. For Nightly Business Report, I'm Mike Santoli.
And joining us right now to talk more about the markets, where he's finding opportunities following last week's sell-off, Barry James back with us, president and portfolio manager at James Investment Research. Good to see you again. Welcome back, Barry.
Hi, great to be with you.
Mike mentioned new leadership. You feel like the smaller caps are the new leadership for this market. Why?
Well, it's like what Yogi Berra said, that giving directions to his house, he said, when you come to the fork in the road, take it. And I think we've hit that fork in the road right now. What we've seen up to this point, it's been all large cap, all growth, all tech, all the time. And we've seen a bit of a change this year. If we just look through the end of last week, small cap stocks haven't gone down as much as the large cap. And as we look at small caps, there's a couple of important things I think that are different. One is valuations. If I look at really small companies versus really big companies, they're cheaper by valuation methodologies. Secondarily, they're not impacted by all this tariff stuff quite as much because they don't necessarily do that much exporting and have those problems. And lastly is this tax reform. If you look at the effective tax rates on companies, small companies have had higher effective tax rate, so they will get more of a benefit. So you got those three things. And just one other thing I'd add is when we come to these forks in the roads in the past, I look back at 1999 and then the year 2000, all that tech stocks running, the NASDAQ fell 39% in 2000, while the small cap index was up, and you heard me right, it was up 22%, the value component of the Russell 2000. Right. So there are opportunities out there, and maybe we're rolling over into the small area.
Well, speaking of which, we asked you for some opportunities, and you gave us a few stocks. Western Digital, that's a tech play for you. Why do you like it?
Well, it is in the tech space, but it's not expensive. It's only running, I think, around 11 times earnings. The earnings are very strong. It had been at new highs earlier this year, and then just recently pulled back. So we've got a little bit of an entry opportunity. It does the steady state and other hard disk types of drives, and everybody needs more disk space. That's for sure.
You've got the Radian Group. Interesting play here. They are the largest PMI insurance company. So you'll like the insurance component maybe for interest rates and also the mortgage component, huh?
That's right. Not many people pay 20% down and can avoid that insurance. So that is something that we think is going to go really well. They, as you said, are the largest, and last year was a record year. I think for them. We might run into a few problems with the rising interest rates, maybe slowing down some purchases, but I think there's a built-up demand there, and they've had really solid earnings up to this point. So with this little bit of a pullback, maybe a pretty good opportunity. Again, cheap company with solid earnings.
You also like gold, physical gold in particular, and it's been performing quite well. It moved up above what is considered a key technical level, the 200, what they call the 200-day moving average. But you also point out it can be held in IRAs.
It can. These exchange-traded funds offer you something that maybe is a little harder to do with the physical components and all the headaches and hassles and so forth that come with it. And of course, you have incredible liquidity with it as well. One of the reasons we like gold is it moves typically the opposite direction of the dollar, and the dollar has been a bit weaker, so gold has been in an uptrend. And when you get these times of turmoil, gold tends to hold up pretty well, and it does tend to anticipate future inflation. And some of this tariff stuff is inflationary.
Barry, always good to see you. Thanks. Barry James,
good to be with you,
with James Investment Research, joining us.
It is time to take a look at some of today's upgrades and downgrades. Morgan Stanley is raising its price target on Microsoft to $130 a share, the highest level on the street. That price indicates a 50% rise in the stock price and a $1 trillion valuation. The firm expects Microsoft's dominant share of the cloud market to grow. The shares rose 7.5% today, making it the best performing stock on the Dow index. Fellow Dow component Intel saw its rating upgraded to market perform from underperform over at Raymond James. That firm cites a strengthening of underlying business conditions. The analyst there does have some longer-term concerns, including the return on Intel's investments and the steady decline of the PC market. But nonetheless, Intel was the second best performing stock on the Dow index, up more than 6%.
Elsewhere, Advanced Micro Devices saw its rating cut to negative from neutral over at Susquehanna. The firm says that AMD faces increased competition from a cryptocurrency chip from China. Price target cut to $7.50. Shares fell nearly 2% to $10.44. And Dollar Tree saw its rating raised to overweight from neutral at Piper Jaffray. The firm saying the Dollar Tree is making what it called sensible investments in its Family Dollar unit. Price target was lifted to $112 a share. The stock rose more than 3% to $95.21.
Still ahead, despite a cooling of those trade tensions, some farmers still don't feel any better.
I'm Aditi Roy in Romney, Indiana, where some soybean farmers are getting increasingly nervous about the trade tensions between the U.S. and China. I'll have that story coming up.
There are reports tonight that San Francisco Fed president is the top candidate to become the New York Fed president. John Williams must first be formally nominated by the New York Fed board and then approved by the Board of Governors. His views do fall in line with the current approach of gradual interest rate increases. The New York Fed president serves as vice chair of the policymaking committee and supervises the big money center banks. It is considered one of the most powerful positions in the financial sector.
Despite a cooling of trade tensions, at least today, some farmers are nervous. Aditi Roy has the story from the Heartland.
Welcome to Romney, Indiana, where you'll be hard-pressed to find a traffic light or anyone out on a Sunday afternoon. Homes and businesses are decorated by American flags, and the region is blanketed by farm fields which produce soybeans, making this bucolic town an epicenter for the trade tensions with China. Brent Bible owns Stillwater Farms on the west side of town.
When will you start planting?
We hope to start planting in about 2 weeks.
Once the snow recedes and spring gets underway, half his fields will be filled with soybeans.
Essentially, this is one of the bins that we store our soybeans in.
But he's rethinking his crop plan amid chatter about China lowering its soybean imports from the U.S. to retaliate against U.S. tariffs.
It's frustrating to think about the government can affect policy that's going to negatively impact our price. It's the difference between a profit for the year and a loss for the year.
The stakes are high for American soybean farmers like him. China is the top importer of U.S. soybeans, buying $14.5 billion worth of the product, which makes up a staggering 61% of all U.S. soybean exports. The war of words has become increasingly heated. Just over the weekend, China's former finance minister reportedly told a public audience, "If I were in the government, I would hit soybeans first." And U.S. agricultural groups like the American Farm Bureau Federation are speaking out too, saying farm income across commodities has fallen by about 50% over the past 4 years. Retaliation in the trade arena makes the outlook even worse. But some analysts who follow soybean futures aren't as worried, saying China's demand for soybeans is so large it cannot shut out U.S. supplies in the long run. That's little consolation for Bible, who's now closely monitoring events half a world away.
What we see is that the ag industry, the ag economy, is very likely going to be the first casualty of the trade war.
Besides soybeans, fruit, wine, and pork are some of the other agricultural products mentioned by China as possible retaliation targets. For Nightly Business Report, I'm Aditi Roy, Romney, Indiana.
Lowe's CEO is retiring, and that's where we begin tonight's Market Focus. After a 13-year stretch as chief executive, Robert Niblock says that he plans to retire from the company once a successor is found. The home improvement retailer has struggled to keep up with rival Home Depot's performance and recently added 3 new directors to its board following calls by an activist investor. Shares of Lowe's rose 6% to $89.30. Hedge fund Third Point, which is run by billionaire investor Dan Loeb, has taken a stake in United Technologies, that according to a regulatory filing. Earlier this year, United Tech said that it was exploring whether to keep the company intact or break it up. Shares today rose by 3.5% to $126.64. And construction materials company USG said that it has turned down a nearly $6 billion unsolicited takeover offer from German rival Knauf. USG said that the offer significantly undervalued the company. By the way, Knauf is USG's second largest shareholder. Shares of USG jumped on the news by 19% to $40.03.
The retailer Finish Line said it will sell itself to Britain's JD Sports Fashion for more than $500 million. Finish Line said the merger gives it a stronger position in the athletic apparel space. Shares finished strong, up 31% to $13.83. Shares of General Electric fell today, hitting a near 9-year low at one point. There was no announcement by the company that prompted the drop, but a Wall Street Journal article published last night raised questions about risks that could stand in the way of the company's turnaround. The report said investors could face risks stemming from GE's former lending businesses and the company's exposure to subprime loans. GE shares finished down 1% to $12.89. And Campbell's Soup has completed its $6 billion acquisition of the snack maker Snyder's-Lance. The deal will shift Campbell's focus away from meals to snack products. To reflect the change, the company is changing its name to Campbell's Snacks. Campbell's Soup rose a fraction today to $42.47.
Wow, changing the name. Nation's oldest gun maker, Remington, has filed for bankruptcy protection. Company sales have been declining since the 2016 presidential election, the thinking apparently being that gun control regulations would be less likely under President Trump. Last year alone, Remington sales were down more than 30%. Remington is also facing a heavy debt load and a number of lawsuits.
And as overall gun sales slow, so does business at America's gun shows. Jane Wells picks up the story from Costa Mesa, California.
As many Americans marched across the country Saturday demanding new gun restrictions, including tens of thousands in Los Angeles, not one protester showed up at California's largest annual gun show, the Crossroads of the West show at the Orange County Fairgrounds. But in the gun showdown, gun show traffic appeared down.
When we drove up today, I thought, wow, where is everybody? I actually thought maybe it was canceled.
It was a little bit slow starting. We only had a 15-minute ticket line, but it's very busy inside.
Inside the show, merchandise ran the gamut from collectibles to, in one corner, Nazi memorabilia. But the most popular attractions were the assault rifles, AR-10s and 15s, which faced the greatest threat of being banned. There's a new law in California that bans AR-15s from having magazines which detach easily from the outside. You have to take apart the gun. It slows you down. And so one of the hottest new products here are these kits which allow you to take your existing AR-15 and convert them to be compliant under state law. The owner of the show says traffic has been down generally since Donald Trump became president, as gun owners are less fearful about more legislation, though some of that fear is now returning.
We're getting quite a few people that are interested in joining because they're interested in protecting their gun rights.
That's especially true in California, though some believe compromise might be inevitable.
There's common ground, and we need to seek that so we can begin a dialogue with between the two sides, but it's such a polarizing issue.
Well, you know, California is, in my mind, a little bit over-regulated. But my opinion is that if the rest of the country was as regulated as this, we'd have fewer problems.
That's probably not the most popular opinion here, but one that may signal change could be coming. For Nightly Business Report, Jane Wells, Costa Mesa, California.
Now that new legislation is in place, several significant tax breaks are going to disappear, and your 2017 returns will be the last time you can grab them. Coming up, what's going and what's still in play for you to claim. Despite experiencing one of the longest bull markets in recent memory, state and local pension systems are still underfunded. Investment returns have been uneven and funding levels have not yet recovered as a result. According to Reuters, which cited analysis by Wilshire Funding, back in 2007, the median funded level was 92% for state retirement plans. In 2016, that had fallen to 68%. Lower funding levels, of course, mean that more money is required to meet future obligations.
Favorite time of year. The countdown is on for the April 17th tax filing deadline, and it's the final call to claim several tax deductions that will be going away after this year. So Sharon Epperson joins us as she always does at this time of year. It's great to see you,
with
Sharon.
The good news.
See you too. With the great news. Great news.
This is the last time taxpayers can file their federal returns under the old tax law. So as they do that and they compile the paperwork, what do they need to remember?
Well, we know there's been a big overhaul of the tax code, and one of the most important parts, of course, is going to be the doubling of the standard deduction going forward. That means a lot of folks may decide not to itemize. But on top of that, itemized deductions are going to be less generous than they have been in the past. And you add to that, the personal exemptions are going away. There are a lot of changes that are taking place that people need to be aware of. So now is the time to look at those tax breaks that are still here and take full advantage of them.
All right, so which breaks go away?
Personal exemptions and dependent exemptions, that's $4,050 if you're for you and your spouse, or if you're taking care of someone else. So that's significant, and that is going away. The other is a number of miscellaneous itemized deductions. Those that exceed 2% of your adjusted gross income are the ones that you can deduct now. Things like job expenses, things like tax prep fees, investment-related fees. These are things that people don't always consider. Hobby expenses, if you're actually getting income from a hobby that you're doing. So those are ones that you want to take a look at again. If you've moved for a new job this year, in 2017, at least 50 miles away, that is something that you could also deduct, and it could be above the line deduction. But going forward, you can only do it if you're in the active military, if you're active duty and you're doing it because of military orders.
Because they ordered you, yeah. There are other deductions that we thought were going away, and they are eventually, just not this year. So
they're back again for 2017. So that's a good, we have to look at some silver lining here. So if you pay mortgage insurance premiums, we have to, because, you know, those of us who haven't finished our tax returns have to do this. And exclusion for foreign debt, that's another thing to consider. But if you had a short sale or loan modification, normally, you know, you would have to count that as income. You don't have to do that in this regard. Tuition and fees for college expenses, that's up to $4,000 that you could possibly get a tax break on there. And if you have done some home improvements and there's an energy efficient window you put in or door, you can get up to $500 tax credit, even better than a deduction.
Can you just follow me around as I do my tax things?
Well,
can you help me and remind me to do mine?
I was going to say, you don't do your own. You're always the last one.
I'm always the last one. I'm always the last one. But I will get it in. I'll get it in on time.
Sharon.
All right, take care.
And that will do it for us on Nightly Business Report. For all of us, including Sharon, thanks for joining us.
I'm Bill Griffith. Enjoy your evening putting your taxes together.
Yes, exactly.
We'll see you tomorrow.